We're back. Saturday stream, boys and girls. We're doing a Saturday. We usually do during the week. We're doing a Saturday. We out here. Join the stream. We're about to do all the financial boring stuff. All right, well, there's some other big news coming to the stream today for anyone who's going to see this. Not only are, this is the report card, and we've pretty much done everything besides the financials, so we're going to dive into the really fun stuff, as I like to call it, the financials, and then we'll have to see if we get through most of it today, what an accurate price point looks like for us. But we have a new unveiling today. An unveiling like no other. We got a hat. And we're going to put that Pear front and center. So, cooking up something new. Pear does. And this episode, or this stream, this series is there we go. This series is stocks. Pear does stocks. I was thinking about getting something. It's like a headpiece to wear, but I feel like that maybe that'll be an evolution. Maybe we'll upgrade to that, but it didn't look too comfortable to be wearing for an hour every day. All right, so this is our tear sheet. Market cap's changed a little bit since we put this together. They haven't come out with any new quarterly information that I've seen. I don't think they released early. I know they're on a different fiscal calendar, but that shouldn't change when they release their earnings. So we're going to dive into the historicals, and luckily they end their fiscal year in June. So what that means for us is we already have their yearly cadence. So we can kind of see what everything looks like going back 5 years. It looks like they restated in 2021, but no worries. All right. So I think what would help is, first of all, I want to capture the most important parts of the income statement, but I also want to, wow, but that caught my eye. Oh, that's net income. Damn. Take the most important pieces and then trend them so that we can see what it looks like. So let's, for instance, total revenue would be something to trend, right? This is interest and investment income. This is more than likely revenue from operations. Yeah, here's the cost of goods sold. So there's the gross profit. There's their SAG and R&D. That's why they're negative. So they're I don't know what they're spending R&D on. $501 million. Right? When their operating income is negative $600 million. So right there, that's a huge chunk. And then their SAG expenses, which is a lot. It's nearly the same as they're generating revenue, right? They're basically the same. Other, we already have that. Operating income, interest expense. They restructured. These are one time. Yeah, we don't really. That's null. All right. So we're gonna do this. We're gonna copy this. We're gonna make a fun little. There we go. Change the color to Affirm. No, that's black. To Affirm. Change this to a little gray. Yeah, there we go. We're gonna put. I think these are the most important. Because this is earnings before taxes, including unusual items. Oh, okay. So they here. We need to figure out what this is. One of these years, they gained 90 million from unusual items. Okay, I will be right back very, very shortly. right, we're back. We're back, and we're back. All right, so let's start building this chart out. I think something that is notable. Now they're very clearly breaking out. I want to say the revenue from non-interest generating objects, and then they're bucketing like everything, like even the paying like 60, right? They're gonna bucket that under the interest revenue generate, interest and investment income. Sorry, I want to assume this revenue is from the percentage that they're charging merchants, but we'll have to dive into that. But regardless, I think we should trend this, and this. Let's see. Well, not this. This is negative, so that won't go over well on the same graph. So, new slide. Not a bar, I need a line. Open, and I think we're gonna call this there you go, 19, 20, 21, 22, 23, 24, that's 6. Whoops. All right. We'll call this one revenue. And we'll call this one interest and investment income, revenue. Let's do this. What are my axes? So my X, oh, that's why. No, this should be my X axis. B1 to G1. Oh, it's only by column. All right. Twenty 2020. 2021, 2022, 2024. No italics, get that off of there. Revenue, So I'm gonna paste this below it and then copy up to paste. No. All right, so that's done. Let's get rid of that. Copy that, put that back here. This was interest and investment income. Interest and investment income. And I think we'll put the totals as dashed lines. Total revenue, because we're gonna have a couple on here. One second again. Get me some coffee. Oh, Sal, what's going on? Yeah, you removed that comment. I don't know what that hate's coming from. I love you, my guy, but not like that. Total revenue. All right, let's copy this one over. If anyone ever sees this stream and you need a wellness coach, you need some breath work, hit up Sal, Salvatore Liberti. Sal, you're my only viewer, but don't be afraid to drop that link. He is the best in the business. That's a testament from myself as well as my mother. You know, I couldn't recommend a better breathwork specialist. I could not recommend a better guy, and all around what seems like a good travel partner as well. So definitely check out Liberti Breathwork. You won't regret it. All right, so we got total revenue on here. Cover up the shindig. Let's paste the format. Format only. Let's edit. Data range. Is it falling out? It shouldn't. Oh, it's because it's not. It's not being picked up. Edit chart. Let's add total. There we go. But let's make this one dotted. It's a total. I think that's worth it. How do we do that? Customize. Here we go. Series. No, total revenue. Series, not you. We want a dash. A little gator color, but we don't like that. All right. What are the ones we got on here? We got cost of goods sold, gross profit. We can add the expenses on there as well. So let's do this. Let's make let's make the revenue generating lines, let's make them different shades of green. I like that. So there's one green. There's another, oh, that's two. What about that green? Yeah. And then we'll do, no. What about that? What about blue? Let's do blue. Blue might be a little bit easier. So we got blue. We got blue. And we got blue. Okay. We'll do the expenses. Cost of goods sold. Cost of goods sold. So one thing to notice with a company like this is they're not selling like physical product. They're selling a service. They have digital products. So their cost of goods sold, I would imagine a lot of those expenses come from maintaining the network, making sure that the if they have to pay interest on the loans or whatever they have to pay to the bank, that's probably another cost of goods sold. But we can see, like noted before, something flipped. It's always been a little bit more than their straight revenue generation. It was cheaper here, and it started going back to where we're having to rely on more than just one line of revenue to negate the cost of goods sold or to cancel out, right? So I'm not too worried about it, but it is something to note. .9, 686.9, 912, and 1328.5. Cost of goods sold, we'll put this one as red, or red orange, so we'll put that one as no, as that. And we'll put maybe they shouldn't be on the same one. That's a debate. Gross profit. Revenue shouldn't be dashed. Maybe that should stay, and then we change this to dashed. Yeah, let's do that. Gross profit can also add gross profit 54.4. Oh fuck. Okay. Well, I gotta change the color to back 160.9. 43 1.6. 262.4. 67 5.5. 994 1/2. Let's add back in the cost of goods sold. So we want, yeah, it's too clustered. All right, well, let's remove some then. Cost of goods sold, let's get you out of there. And gross profit. Series, not Siri. No. There we go. So total revenue is clearly increasing. It's almost compounding, really. Delete those. We don't want this to say point score. We want this to say total revenue by year. Actually, we can just say total revenue. All right. Update this. We got that. Let's go back here. Almost deleted that. That would have been bad. All right, let's insert a page break. And we will call this where's the other document? We can call it yearly financials. So first thing is to take our slide, put it in there, paste. Make another one for insert. No. Let's make another one. Insert chart line. Get rid of these. Okay. Do I want gross? Do we want gross profit on there and operating income? Operating income is negative. I think we should have that on there. And gross profit. Okay, let me go back and edit this. Edit. All right, let's get, where is it? Gross profit and operating income. $54,400. 160.9. And 994.5. And then operating income is negative 127 million. I need to change the scale actually. I'm assuming it's a million. Actually, oh, here you go, in millions, yeah. Negative 107.8. 372.1. Negative 866. Negative 1161.9. Negative 1161.9. Negative 607.3. Negative 607.3. Edit chart. Gross profit, and we need operating income. We can change the gross profit, change that to another dash, and put that as another green. And then we can put the operating income as a red and that as a dash. Let me change the gross profit. Let's put that as a yellow. Edit. Actually, can I do it from here? I want to move the... there we go. Move the legend. Let's put it on the right. I meant right. No, that's bad. Let's put it on the bottom. There we go. And now we need to change how do we change the... Here we go, vertical axis. It's on the million scale. No. No, I don't want it on a log scale. There we go. Currency. And how do we... I kind of want to test this. What equal... How do we... If this were to be equal... times 1 million. What happens if I vertical? What happens if we change this to that? Does it say? It does not. Okay. So we'll have to put a disclaimer. I'll just call this income statement. So okay, so we're gonna have to do something for the expenses to tell a story. Let's get rid of this. Oh, actually, can I do this? There we go. Let's open that source. Call it this. Okay, and then we can change it to this. So we got cost of goods sold. Cost of goods sold. Other operating expenses. I don't think we need to include this to tell the story because they're one-offs. They're unusual items, right? Like they impact the balance sheet and the income statement, but they're not something that we should be seeing heavily. And then I want to also do the EBITDA. I should probably do that on the other one. Yeah. So let's finish this first and go back and add the EBITDA. And the net income, I didn't add that either. EBT. Excluding unusual items. The cost of goods. I don't even want to do earnings before taxes. So I'm just going to remove that one actually. So remove that. And then other operating expenses. No, we'll do SAG and R&D. And then R&D. R&D expense. Top one is SAG. bottom one. Whoops. Edit. Let's R&D expense it. Customize. Series. No, cost of goods sold we can do as yellow, and then let's do that as a red. And then we'll do the selling as a yellow. Expenses. Edit, customize, vertical. We want this currency rounded. Put this in millions. And we need to add another one. And we're going to call this one so I just need to copy all that. All that's good stuff. Because the EBITDA and everything is below. So we will put that here. Whoops. Net income and EBITDA is what we wanted. Net income. Net income. And then we'll do EBITDA. Net income. Copy, paste special, format only, and then EBITDA. Okay, now we need to include those. All right, actually, date goes to H. Now we can include those. Net income, EBITDA. And we'll go to series, net income, not Siri. Siri thinks I'm talking to Siri. Net income, I don't even know what other color to give this. I want to give it a green, but fuck it. Let's keep it what it is. And then EBITDA. Everyone's least favorite cousin is EBITDA. We'll put that one as like a purple. what if we put the legend on the side, right? Can we put it in the middle? Can I move it? We can, but that just looks dog shit. All right, let's keep it below. What happens if I update? Okay, boom. So they're trending the same down here. Obviously, it has depreciation, amortization taken out, net income. They're all sides of the same coin at different at different parts of the making, I guess. All right, let's update this. There we go. Where is the left? There we go. And I wanna. There we go. Nope. Okay, and then we can put our expenses one as well. A little different because there's so much more on this. Let me show the edit. What was that? The X? No, the Y. Vertical. Show axis line. So update that. And then update that. Boom. Okay. So our income statement is pretty much all visualized. I don't know what's going on with their SAG costs, selling, general, and admin. For those who don't know, it's like everything else, anything else that goes into how they operate. So employee, right? You need someone to operate the phone line. You know, that is not going into selling the good, but that is helping you sell the good. Just high level. Think of every other expense that's going to go into operating the company, but doesn't necessarily impact the production of the good. All right. So we have the income statement. We have. Honestly, I think we should change that from income statement. We should just call this income. All right. We got the income. We got the expenses. Totally different charts, size, and what they're showing. But I think this gives us a good picture of the high level. What do they look like as a revenue generating company, albeit they are negative. We knew that coming in here. Their operating income is negative. But that also doesn't mean that that's bad, right? Amazon was negative. Tesla has operated negative for years. I think they recently turned a profit maybe a year ago. And so this definitely is a capital intensive enterprise. We know they have a lot of debt. They also sell a lot of debt to the public. And so I wouldn't take this as this is everything else. I wouldn't take that as a worrisome sign, but I also wouldn't, say, hey, look, this company's totally going to bring in cash. I mean, they are, but they're not able to give that back to the shareholders yet, right? You can't give negative dollars, which is why if we go down here, you look at their diluted earnings per sale, basically the same as their basic, but one's including shares that's open to the public, the other is not. And for the most part, they operate the same. We knew they bought some outstanding or some, they did a stock repurchase. But anyway, their EPS, earnings per share, how much of the revenue is going to shareholders, because their net income is negative, that is then spread across all the shares that are outstanding. That should also be on here. If it's not, it should be on the tear sheet. Shares outstanding, 311 million. So just to show you how it's done, right? Thankfully, the calculator on the iPhone is updated now. You don't have to turn it sideways the whole time. But what's their net income? Their net income, 517 million. Now remember, this is negative, so we're going to have to add a negative sign in the front. Divided by 311, and I'll put the negative sign. I don't know if you see that. Negative 1.66. If we go to the EPS, negative 1.67. Literally the same thing. There's rounding that's not accounted for, but that is how you get the earnings per share. And right now, I don't think they're going to be issuing more stock because they have a lot of consumer loans that they bundle together and they sell as asset-backed securities. So I don't think they necessarily need to raise funds by selling more stock. That is an assumption. That is not true. That is not financial advice. But because of that, I think we need to focus more on the net income piece more than the dilution of, let's just say, shareholder equity, right? Issuing more stock. So if we go to the net income and we look at how it's trended, we go back to our little slide here. If we look at the net income, which is this green line, it was taking a little bit of a dive, right? But they turned it around this year substantially. We go back to the numbers. We can also see that. Where are we looking? Where are you at, net income? Net income, where are you at? I'm blind. Here we go. Substantially higher. 2022, 2023. Picked up 2021. Now, we know there was an influx in purchasing during COVID. So this could have been ramping up. This could have been a whole number of things. But we do know that the revenue is increasing, right? So what is causing the net income to be so low is the operating expenses. Their operating expenses, nearly $2 billion in operating expenses, and they're bringing in $2 billion in total revenue. It's a huge jump from the year before. So if they keep increasing their revenue, right, we're going to assume, every company wants to reduce expenses, but looking at their current cost of goods sold, increasing, looking at the R&D expense, increasing, little low this year. They might start to chip away at the expenses that they can control, but they're really trying to drive that revenue growth. The more consumers that use their network, the more that'll grow. It's a positive feedback loop. Again, we've talked about this, where if you are an unbanked customer, if you do not, let's just assume you are living in a city or a place, let's take the US, where you're not familiar with banking structures, not familiar with a savings account even. Let's just say you keep your money at Bank of America, right? Bank of America, for the most part, does not offer high yield savings accounts, right? You can open up a savings account, but that'll only give you 0.05% interest, maybe 0.1%. And that's not much. Your money is not growing. And we're going to assume that you are not someone who is invested. You're not someone who, or this person, not you. This person is not someone who's invested. This person is not someone who knows anything about that. But they have used Affirm before. They know that Affirm, they can get a loan pretty much anywhere. We just went to City Furniture. Not that we would finance through Affirm. They didn't offer great terms, but they didn't offer great terms comparatively to the furniture store. But if you have an Affirm account or you're used to Affirm, you can purchase these items that you otherwise didn't have cash to before, right? So knowing or getting people on board is the first step. Once you are accustomed to Affirm, even not, if you are looking for a savings account, you could definitely look to Affirm. It's a little bit lower than other online savings accounts, but let's just assume you're a customer who uses Affirm and you are familiar with their products. You can now use the Affirm money account for 4.5% interest. So any cash that you have, you can use them as a savings account and then use the money in that savings account to pay off the loans that you have. So once they have your capital with them, the same way that any issuer of, I'm just gonna say currency, but in this case, USDC, Circle, you give them money, they hold treasury bonds, they then use your cash, your liquid cash, because they already hold the treasury bond to do other things and invest with. Same as a mortgage. This is just what goes on with lending, right? So the customer gives the cash to Affirm. Affirm will use that cash appropriately. They're buying treasury bonds, which let's just say the treasury bonds are 5.5%. I don't think they're that anymore, but let's say they are, and they're offering you 4.5%. They take the 1% as a profit, but then they're also using your cash because it's liquid. But besides the point. The point is that they can generate this revenue in the future, assuming that, number one, more people are going to notice their products that are already using other products in their suite. Number two is that the network effect will grow. More people will not only join Walmart, more people will join Amazon, more people will join Target. These are their major partnerships. Just like I said, went to City Furniture. They're using them. Verizon's using them. All these different consumers are giving you the ability to buy now and pay later, which helps them out as well. They get cash immediately, or rather faster. And so as they grow, as more customers use these services, their revenue will grow, right? When the revenue grows, assuming that the other expenses, if they do grow, they grow at a lesser rate, or they grow at the rate at which we're seeing in 2024. So a little lower, maybe they can cut some places. But again, it's that self-reinforcing loop. Max said in their shareholder letter that he envisions them to be positive in 2025. Take that with a grain of salt. I think every CEO envisions that. But I think right now that is the culprit to this. So I'm definitely going to put that as a note at the bottom. But that is something I truly believe that I don't think they need to issue more stock. They have a bunch of other debt instruments that they can issue. It also unloads the risk, right? If they're packaging the loans that you take out with them. So let's say I take out a $500 loan. You take out a $1,000 loan. Instead of holding those loans on the balance sheet, right? They're going to say, hey, we're going to package these loans. So $1,500, what did I say? $1,500, $1,500 in loans. Let's say that the APR isn't baked into them. So this is hypothetical here, but you and I did not take out the pay in full. These loans were, let's say 60-month loans. So let's just say we each have half of what we are taking out in yield. So that would be 50%, but whatever. So 500 is 250. So I have $750 that I'm taking out. You have 1,500. Or you have 1,000. That's now 500. So 1,500, right? So 1,500, 750. Quick math. It's like 2,250. And so what they'll do is they'll package the loan and say, hey, you can buy these loans, $1,500 worth of loans, with a yield of 20%. Now, that's not all the yield. If we recall, right, 500, just to show you quick maths. Whoops. I don't know how to get out of this calculator. It's all funky now. But I'll show you. 500 times 50%, right, 250. So let's just assume that's what's going on. I don't think it's that high, but just as an example, they'll package the $1,500 loan. They will sell it to private investors and say, hey, This is a asset-backed security. This is to be sold, and it's going to have an annual percentage yield, let's say 20%. So while they are now selling you the loan, getting cash for it, they are also keeping that extra interest for themselves. So it's risky, yes, but it is somewhat lucrative. I have my 2 cents about it because, as we've talked about before, it does kind of resemble what happened in 2008 with mortgages. Now, I don't think they're going to get to that point yet. We saw that 650, or the credit score, I think it was 650. Whoops. I think the 6 something. It was like the credit score of most consumers was like 600 something. I don't see it. But that is what it was. You just got to believe me on that one. And yeah, I think you don't have to worry about that just yet. But in the event that people do, it's a catch-22. The more expensive things get, the more people are going to have to use this service, which is tough, but it's necessary, right? Unfortunately, we don't, in a capitalistic society, have universal basic income. We don't have these things that supplement people's lives. So people are going to have to find other means to sustain themselves. So if costs increase or things become more expensive, people are going to have to use this service or services like this. Big purchases like furniture I was just telling you about. Financing is huge. Considering financing, just because like they're paying for it, no interest, you're borrowing someone else's money. You know that you can pay this in time, but you don't want that cost up front. So the expense or the cost of living increasing is one aspect, but then you have the other aspect of, okay, well, if the cost of living is increasing, and we know that to be true, right? If the cost of living is increasing, what happens when people can't meet all their expenses? You're going to have defaults. You're going to have people that can't pay the loans back that they own. That is what we saw in 2008 with the housing crisis, right? People had these mortgages that they could no longer afford, and so they started defaulting. At least in the situation with the banks in that scenario, they had collateralized loans. The houses were collateralized with the loans. So although the bank and the entire economy suffered, the banks still had these houses on hand that they could then sell to recoup some of their losses. In this situation, they are uncollateralized loans. And by that, it means there is nothing backing the loan besides the credit score of the individuals, right? These right here. We see that nearly 50% are near prime or above, right? So 659 or 620 or above, which is not terrible. It's not the end of the world. It's not 800, but it's not 500. What will happen though when expenses become too great and people have too many loans out? They will start to default. They will not be able to pay their loans. And while Affirm does send these to credit agencies, right? They send them to third-party agencies, not credit agencies, third-party agencies to recoup the loans, right? They sell them for a lesser price. These investors that now have invested money into these asset-backed securities will start to falter because the loans are not coming due. So the yield is not, it's not what they expected. They won't, the loans won't be able to cover the yield that they said they would. So that is something that we're going to have to research more. What happens in these asset-backed securities when consumers stop paying? They do have 120 private institutions invested. That was at the bottom here. And one of the other things, again, that we need to invest further is that they have nearly $1 billion, I want to say. Where did I write it? $1 billion. Maybe I didn't. Maybe I need to add that. $1 billion from the Canadian pension fund. The Canadian pension fund, right? 1.4 billion from one of the world's largest pension funds. That is retirement money. So what happens when that goes belly up? We're not saying it is, even now, anytime soon, but you can see how this would ripple through. And it's almost as if we are perpetuating a similar cycle with all of these Klarna, PayPal, Affirm, how this can add up very fast. So one, we have to assume that the credit agencies are ranking these loans appropriately or rating them appropriately. But then two, not that this is bad in the short term. It takes a lot for this to happen. I'm very excited about this company, but I do think that is something that needs to be watched. And that kind of goes to our rating here. They have a large amount of unsecured asset-backed securities, which is a huge factor because there is you can't just send millions of people to collections. You're just going to tank a large demographic and create this even larger disparity between different income earners and parts of society. So that's a little tough when investing in this company to know how they make their money and what the future entails. But nevertheless, I think it's a necessary byproduct of what they do offer in the good, right? Which is lending to consumers to be able to do things that they would otherwise be unable to do. So, let me make sure I put that piece in here. I did not think I included that. So I apologize. Funding capacity. I don't think I included that anywhere. As of June 2024. At the end, board of directors. Where did I skip around? Oh, here. So I need to include this. And I need to I just need to include that piece. Okay, so we did this. I don't think we need to update it anymore, which is good. So let's add let's add that missing piece of the Canadian Investment Fund. And just to show you, CCIPB, Canada Pension. CCPB, I don't even know where I got that from. CPPIB. The Canada Pension Plan Investment Board. CPP Investments is a Canadian Crown corporation. Let's learn about them. It's a Canadian Crown corporation established by way of 1997 to oversee and invest everything held by the Canada Pension Plan. Shout out the one concurrent viewer. I don't know who you are. I really appreciate you. Shout out. CPP Investments is one of the world's largest investors in private equity, having invested over $28 billion. Wow. Okay. Well, okay. Here's to put it into perspective as well. $1 billion is a lot of money. $1 billion. Okay, that's Canadian dollars. So let's just even assume that's just, I don't know, 600 USD. Oh, you know, I lied. Canadian dollars to US dollars. My guess would be it's a lot less. Okay, so $463 billion. So the Canadian Pension Fund manages $463 million. Okay, so they thanks, Mom. Thanks for viewing. You like my hat? It's the new edition. Anyway, the Canadian Pension Fund manages 463 million US dollar. Okay, they have an agreement to invest 1.4 billion dollars. Now, 1.4 is a lot, but 463 divided by 1.4. I'm sorry, other way. 1.4 divided by 463 is not even 1%. That's not even 1% of their investment portfolio. So it is a lot of money to invest. Yes. Let's read. There we go. Okay. It's a lot of money to invest, but it's just a drop in the bucket. So luckily, this is not going to impact that many Canadians, but it would, God forbid anything happened. But being that there is a government fund investing in this, a substantial amount, probably also ties back to their relationships with with Wayne, right? Wayne having the being the president of PayBright, which was the largest buy now pay later in Canada, right? I think that connection kind of stands out. But let's put this piece in before I lose track. So funding capacity increased. Did I even include that? No. Funding capacity increased half a billion. So funding capacity increased they're just borrowing more money. July, August, September. This ended in June. June is their year end. July, August, September. They would have released in October. Let's see. Affirm quarterly earnings. When did this come out? When does it come out? Oh, on the 7th. Cool. All right, so end of next week, we'll have more information surrounding Affirm. Shout out. We got another viewer in the party. Shout out everyone out there. All right. Anyway, back to this. The funding capacity increased $500 million over the previous quarter, right? So they are borrowing more money over the previous quarter to $16.1 billion. The increase includes the expansion of our existing forward flow relationship with this gain is largely due to the due to, I believe that means they invested more money. So an expansion in the relationship with CPPIB Credit Investments. Otherwise known as the we'll do this now I'm drawing CPP Investments. Otherwise known as the Canadian CPP Investments. $1.4 billion, I think it was. 1.4, yeah, 1.4 billion. Okay. CPP Investments manages 463 billion USD, meaning the Affirm, making the Affirm partnership 0.3% of their total portfolio. Okay. Yeah. Yeah. No, let me call you in a little bit. All right. Okay, so these are the yearly financials. We've done capital and funding. Yearly financials. Oh, I need to. Let's tag that. So for a tabular view of the income statement. Income statement. Let's get rid of that. Too many tabs, too many tabs. That we need, too many tabs. That. This is what we need. There we go. Okay. Now I need to add that comment. And then that'll be it for today. Okay. So Affirm has many methods in which they raise capital, e.g. ABS. They company notes, bonds, funding, partnerships, etc. And so just so everyone's on the same page, we're just going to look this up just so you can see the actual definition. When a company issues additional stock, reducing the ownership proportion of current shareholders. So again, we have, if we go back here, We have basic EPS, so normal shares, and then with the diluted shares. Fully diluted shares is the total number of shares that will be outstanding and available to trade after all possible sources of conversion are exercised. So, bonds that can be converted into shares, right? Like right here, when they acquire, which we've known they have acquired, but they just finished that acquisition, paying off the acquisition for Returnly, right? They sunset that. So you have what are we looking at again? Here we go. The basic EPS and the diluted EPS. So shares that can be converted, everything else out there, and shares right now. They are the same. So to me, without having to look at the weighted average, you can see that they are the same. Okay. So there's not a lot of these convertible shares out there. So we know that they have issued that in the past, but I think they've repurchased that as a part of the face value that we saw here. Oh, damn. Don't want to do that. That we saw here where they repurchased so much in convertible debt, right? They didn't want that out there. They didn't want these companies basically converting the debt to equity, and now they're losing shares. Anyway, they have many methods in which they can raise capital. And as such, I do not foresee them using or issuing more shares to gain cash. Because of this, I believe the only thing necessary to focus on in raising their net income and thus turning a positive EPS is to generate more, say it with me, revenue. I don't know if I don't want it to come from the interest. It looks like that's growing a lot faster. So we'll just have to make a note of that. And then I'll say this. As previously discussed, Affirm's products generate a self-reinforcing loop. Self-reinforcing loop. In the form of a super app, which they have described it, and if you went to China or you are familiar with Chinese products, they have super app chat platforms like Alibaba, WeChat, where you can buy anything, you can get credit, they basically can do everything. Give me 1 second. All right. So, as previously discussed, Affirm's products generate a self-reinforcing loop in the form of a super app. And then I'm just going to go e.g. gonna do Affirm. Let's go back to the products. Affirm. Affirm money account to Affirm credit card to Affirm checkout. Okay. As more customers join the network and use the product suite, revenues will increase. Revenues will increase. With increasing revenues, hopefully at a faster pace than expenses, Affirm will generate positive EPS and thus finally able to give money. I'm just going to say that. That doesn't mean they're going to have a dividend back to shareholders. All right. Okay. I think that's it for this. We can see they're moving positive. Let's just write another note. Affirm needs to focus on reducing COGS in order to normalize revenue growth. One form of revenue does not cover the entire cost of COGS. Are needed. And as we'll see probably as we move forward, no, we'll definitely see as we move forward. When we go to the balance sheet and we look at their debt, $6 billion in debt. Now they do have $9 billion in total assets, but they have $6 billion of that in long-term investments. We don't know what that is. We'll have to go through more financial documents. But that is not for today. So yeah, thanks for joining the stream today. We'll be back. I don't know about tomorrow, but we'll be back Monday. I'm Pear. This is my cool bucket hat. Hope to see you next time.